Welcome to the Daily Update, where I'll go over the action in the market for Friday, May 26th, and then we'll see how things look for Tuesday, May 30th. The markets are closed in observance of Memorial Day. I want to wish everybody a very happy Memorial Day and a great Memorial weekend if you're doing some barbecuing. We had a pretty strong up day on Friday. Semiconductors were up strong. The tech sector was doing really well. So we're seeing some real strength right now in the growth area. But as usual, there are some warning signs that we need to be aware of. Are we going to be able to keep going? Does it look like we're going to shoot up to 4,300? Or is this just a blow off top before we get set to turn and go back down? Before I get started, please know that I have a supplemental video posted on my channel that you're welcome to watch. It talks about the S&P and interest rates and how they interact with each other. In fact, a few charts from that video I'll be showing later on as they're updating. I do have a PDF of all the slides and charts available in the description because I'm hoping that you'll look at those charts. I'm not able to do the zooming anymore. It's just too demanding on my computer and it takes forever to be able to edit these kinds of videos. I like to get these posted just as soon as possible. So please look at the PDFs. If those aren't doing a good enough job for you, let me know and we'll try to come up with something else. Also, I have a private Facebook group that you're welcome to join. I try to post some additional things in that group. I do have a poll that's posted this week in the weekly video. I'll be going over the results of that poll. Also know that I do post videos on Rumble in addition to YouTube. A little over a week ago, I had some trouble with my YouTube channel. I was offline for a number of hours. If you come to YouTube and can't find me, please jump over to Rumble, go to this channel, and there should be a video there. Let's go back and talk about what happened. Right at the open, we had a higher open. There wasn't much of a gap. The futures were pretty strong. We were up as much as 1% before the market opened, but we pulled back down and had an open that wasn't a huge gap from Thursday to Friday. But prices quickly went up. We went above R1 at 41.68. We shot up above R2 at 41.85. As the day went on, we never got up to R3. That would have been at 42.21. That was about 6 points under the high, but we held on to those gains. We didn't see a lot of selling going into this. We chopped higher, and then we ended up closing above 4,200. So that's kind of a milestone for what we've been dealing with lately. We were up 1.3% on above average volume. So that's pretty healthy to see an up day on an increase in volume. Our technicals have now switched more to positive in the short term. We're still seeing some weaknesses, and I'll go through the charts to show you that. Inflation and interest rates are the backdrop of what's happening right now, but it's really dealing with this debt ceiling issue and can that get resolved and move forward from that. What are some comments that we can make? There are some reports coming out that the debt ceiling agreement could be near, although no agreement was announced before the market closed on Friday. The semiconductor index, which is another one that I go over in the intermarket analysis video, we also call it the SOX index. It gained 10.7% and it's up 18.4% for the month. That's where a lot of the strength is coming from. The NASDAQ and NASDAQ 100 were both up strong on Friday. The S&P was finally able to get above and then close above 4,200. On a short-term basis, we have our usual suspects here. We have the CCI 14 and 20, the Stochh RSI, the Williams Percent R, and the short-term stochastics. Those are giving us extreme positive readings. On an intermediate-term basis, the Sean trend meter has now gone back up and is looking extreme. The dollar was down and interest rates were also down, so both of these could have given a little bit of support to stocks. The 10 to the 5, the 10 to the 2, and the 10 to the 3 month, those yield curves still remain inverted. Sentiment is still positive, and we're not exuberant at this point. We're at 68, which is just the positive side of things, where we had been at 62. Our trend is turning back more positive. We crossed back above the moving average, but both the ADX and the moving average are below 20. Our bias is now back to positive with the update, and I've kept our momentum at mixed. After a 3-day weekend, when folks come back on Tuesday, they might be more in the mind to sell, or maybe they're going to get ready to buy some more. The economic reports that came out, we had personal income. It came in up 0.4% on a month-over-month basis, just as expected, a little bit up from last time where it was up 0.3%. Personal spending, this actually was more than they had expected. This could signal that there's still some growth happening in the economy. It was up 0.8% month over month. They expected it to be up 0.4%. Last time it came in up 0.1%. The PCE price index, this is another inflation gauge. It was up 0.4%, a little bit more than the 0.3% that they had expected. When you take this on a year over year basis, it's at 4.4%. Last time it came in at 4.2%. The core PCE, which takes out food and energy, it came up a little bit greater than expected at 0.4%. They expected 0.3%. That works out to 4.7% year over year. Last time it came in at 4.6%. Durable goods were up 1.1% on a month over month basis. They actually expected it to be down 1%. Last time it came in at 3.3%. If you take out transportation, it was down 0.2%, a little bit more than the 0.1% they expected. Last time it came in up 0.3%. The advanced international trade in goods came in at $96.8 billion, up from the $82.6 billion that we saw last time. Advanced retail inventories declined 0.2%. Wholesale inventories were down 0.2%. Consumer sentiment came in at 59.2, more than the 57.8 that they had expected, and up from last time, which came in at 57.7. Then I have a few Isabel Net blog charts to show you. This one is kind of interesting. This is a chart that we do show in the intermarket analysis video. The black line is the 10-year Treasury yield, where this purple line is the copper to gold ratio, and that's what we follow a lot. You'll notice that a lot of times these two tend to go in the same overall direction, and they tend to not get very far apart from each other. Well, look what's happening now. They're both declining right now, even though Treasury yields were up this past week, but now there's quite a wide spread between the two. Is the copper to gold ratio going to go back up, or are interest rates going to come down? The copper to gold ratio is suggesting that things look better economically going forward. When copper's outperforming, this ratio goes up. When things don't look as good, people get into gold, and then gold starts to outperform copper. With both of these going down and interest rates going down, that could suggest economic weakness going forward as well. We've been talking a lot about the debt ceiling crisis. The Treasury is highly likely to be unable to make payments in early June. Feel free to pause this. I'm not going to go through all these other things here, but this just talks about where we're at and where we could be. Then we look at this. This is the Economic Output Composite Index compared to the LEI, the leading economic index or indicator. It shows them both going down. This is one of the reasons why folks think we're headed into a recession. When you see both of these going down like this, and then you look at times past, we did enter into a recession, especially if we continue to fall with this chart. Looking at a recent post by FactSet Blogs, where it says the highest number of S&P 500 companies are citing AI on their first quarterly earnings calls, a real increase over the last 10 years. You can see it's really spiked up. That's kind of all the rage now. Is that going to be the next bubble? We've had cryptocurrencies. Before that, we had gold, we had housing, we've had stocks. There was tulips, all these other crazy things that have happened during history. Is AI going to end up falling into that camp? Looking at our intraday chart, where we did have a higher open, there wasn't much of a gap from Thursday to Friday, but we quickly shot above R1. We also went above R2 without even really slowing down all that much. We never made it up to R3, which would have been above current price. We chopped around, but kept going higher overall. We were up strong and came down just a little bit, but we did close above 4,200. Looking at the intraday chart, where we had been going down in the initial overnight session and looking a little more negative, but then after Europe opened up, things turned a lot more positive. Then we came back down to negative. Then after the market opened, we saw a real spike up with the SPY. Growth still continues to outperform value. Growth was up 1.26%, a little bit less than value. That's warning sign number one, where the mid caps also underperformed. The small caps were about even. Then looking intraday, we saw this real nice upward move earlier in the week, and I made a post saying, could the smart money be getting into growth? But then when we had the big up day on Friday, we pretty much chopped sideways with this ratio overall. So growth didn't really show a lot of strength on Friday. It had shown it before we saw that big upward move. Economic reports that came out. We had consumer sentiment, the final reading, where it is ticking down to 59.2. We also plot the 2-year yield, showing that there's a really wide spread. Are yields going to come down, or are people going to start to feel better about things? Looking at sentiment, our Ulster index was pretty much flat from Thursday to Friday. We ticked down with the VIX on the line chart as well as on the bar chart. We're under 20 again. Where the VIX of the VIX, which measures the volatility of the VIX, it is also declining with the up day. This is a chart I haven't shown in a while. This takes a correlation between the VIX and the S&P, and it's starting to go up. We're not getting an extreme reading from this right now, but the fact that this is going up as the VIX continues to go down and the S&P is going up, we'll want to keep an eye on this. Sometimes we get some signals from this chart. We're not right now, but we could get one soon. The equity put call ratio still continues to fall overall. We're not working off of a recent signal, but we had some other signals that never really led to much in the past. Looking at the MOVE index, where volatility did increase with bonds, where it decreased with stocks. Down below, this green line is the spread between the two, and then the red line is the S&P 500. We can see where there's a very strong correlation between those two indexes. We also had the latest reading of American Association of Individual Investors. They're still tending to be more pessimistic overall after giving us a pretty extreme negative reading. Another fear gauge that we look at did tick down, but overall it still continues to go up. This other fear gauge is pretty much chopping sideways and was virtually unchanged. Now we're seeing a shift here. This is on the positive side of things, where we had been more in a risk-off posture with the market. That's when this ratio is going down. Well, we were going down, and now we're starting to turn and go back up. So is the market switching from risk-off, which means bonds are favored, over into risk-on, which means stocks are favored? This chart signals that we could be going back into a risk-on posture. Our advanced decline line studies saw just a little bit of a tick up based on price and volume. We're seeing a little bit of a short-term negative divergence still, and also a longer-term negative divergence. The new highs, new lows, they are going sideways right now. We didn't see a real breakout. The hope was if we got above 4,200 that we would see an explosive growth in new highs. We saw some new highs, but not all that much overall. And our 10 period still is flat to slightly declining. The advanced decline ratio is also still underneath zero on a strong up day. That's another thing to be concerned about. Accumulation distribution, though, is positive and advancing above its moving average. That's positive. We're still seeing a longer-term negative divergence with the cumulative advanced decline line of the NYSE, even though it did show some improvement here. With our regular advanced decline line, it ticked up slightly, but has not been able to break out to the upside. The advanced decline line for the NYSE is still breaking below this trend line and ticked back up slightly, but it hasn't come back above the trend line yet. Longer term, we're seeing a negative divergence based on price and volume when we look at common stock on the NYSE. Looking at our advanced decline line studies, where the NYSE did turn up slightly, but it's still below its moving average. The S&P also turned up, still below its moving average, the same as with the mid caps. The small caps turned up, and they have not been able to get above this moving average recently. Looking at our trend indicator, where we're turning back up with the ADX, we're going back above the moving average now. We default to positive because the green line's on top and advancing, but we're still below 20 overall. I'm doing some additional research with a shorter term ADX to see if that will help us at some point. Volume did pick up slightly, but it's still below average overall when you look at it on this chart. On the short term, it's a little hard to see, but I didn't want to take these pivot points out of here where we broke above that and we're back to previous highs that we've set above 4,200. You can see on the bottom where volume did go up above average. Our moving average study, we're turning back up with the 20, 50, and 200, but these aren't really showing a lot of strength, at least yet. A lot of stocks have really been chopping sideways. The Stochk RSI is now extreme positive, as is the Williams percent R. The CCI 14 just barely extreme, and the CCI 20 is also going into extreme positive territory. We're above the 20-period simple and exponential moving averages, so this switches the short-term trend back to positive. And the force index was able to climb back above zero. That's positive. In the short term, our stochastics are looking a little extreme. We're turning back up and looking more positive in the intermediate term, but we're still going down with the longer-term stochastic. Intermediate term charts, we closed above the double and triple 50-period exponential moving averages, so that is helping things to look a little better. The go-no-go system is switched back to a darker blue. That is positive. The TTM squeeze also showed some improvement. The balance of power, though, even though we're going up, we're still below this dashed line. Above this line is positive, below this line is negative. The PPO study, we're still positive in the long and intermediate term and showing some improvement in the short term. Our Arun indicator hasn't changed for a few days. It's still positive overall. The McClellan oscillator, after giving us an extreme negative reading, is now bouncing back up, but it's still negative. The NYSE McClellan oscillator is still below zero, but it is showing some improvement. The summation index based on price is falling and in danger of dropping below zero. We have turned back up now based on volume. Sometimes this is a leading indicator, but this last time it turned back up, and that was a fake signal. So we want to get confirmation that price is actually turning up, not just volume. The Swenlin trading oscillator didn't really show a lot of improvement based on price or volume in Friday's session. The PMO is still chopping around above and below its moving average. We're still negative based on price. We crossed back over based on volume, but now we've turned back down below the moving average. The PMO study showing a little bit of improvement, but a longer-term negative divergence. The buy signals still continue to decline, and the PMOs that are above zero is also declining. On the positive side, the parabolic SAR still remains positive. The Elder Impulse system for the S&P is positive. The slope indicator is now crossing back above its moving average. This is our touchiest oscillator, so we watch it pretty closely. The MACD is trying to turn back above its moving average, but hasn't quite done so yet. So when you look at all of our oscillators, some of them are showing improvement. We're watching the longer term ones with the TRIX and the KST. Can they switch over and go positive? We're above all the plotted moving averages in our moving average tree. Here's another warning sign. On an up day, we saw a decline in the BPI. So that is something to be aware of. The NYSE bullish percent index also declined. The Sean trend meter is starting to get back extreme positive. The Chaikin money flow is showing a bit of a decline. Even though it's positive, to see this going down on an up day is a little bit concerning. Chaikin oscillator, though, did come back above the dashed line and is looking more positive. The money flow index continues to go up. That's positive. The ultimate oscillator is above 50 and advancing. That's positive. The vortex, another warning sign. It came down on an up day, even though it is positive overall. The RSI, both based on 14 and 9 periods, have now crossed back above 50. That's more positive. On balance volume closed above its moving average, so that's turning more positive. Then we're still seeing a longer-term negative divergence with the 250 period moving average study showing those stocks are just not participating in the upward movement, even though it did improve a little bit on Friday. The Copic curve is still generating a buy signal. That's positive. The Pring bottom fisher has now generated a buy signal. Looking at our line studies, we're still above this 4170 level. If we start to fall, will that offer support? And we're above the 100% retracement level here at 4123. Longer term, we broke through this 50% retracement level at 4156. So if the S&P starts to fall, we'll be looking at this as potential support. Longer term, can we break above this 4214 level? We weren't able to get up that high on Friday. Can we get above that and close? That would turn things much more positive. And we're now starting to come out of the upper side of this downward sloping trend line. We initially hit this and then started to come back down. Well, on Friday, we were able to close above this trend line. That could be positive. A week ago, we did have the end of the 50-day cycle. So now we're 7 days into this new cycle. We thought it might be switching down to negative, but with that up day, that's kind of making this chart not as useful. Looking at our different charts, the Heiken Ashi is turning more positive. The Kegi chart is black and pointing up. That's positive. The Renko has redrawn to look more positive. And the 3-line break has also added some bars here to look more positive. Looking at our indexes, the equal weight did show some improvement, but it's still underperforming the S&P. The S&P is still right about at this level here. It's trying to break above 4,200. Can it continue? Or the NASDAQ is just on a tear these days. However, the transports still continue to underperform the Dow. That could be longer term negative. The equal weight compared to the S&P 500 shows that the big stocks are really outperforming. The Dow was able to bounce back up off of its 200-day moving average, but it's still below the 50-period moving average, and we have a pivot level above current price. The diamonds have switched from being negative to back to neutral. The NASDAQ is just breaking out all over the place. And we're above this 38.2% retracement level. Can we get up to this 50% level? That's still a ways away, but that may offer some overhead resistance. But on a negative side, we're seeing the new highs minus the new lows, and take a cumulative count of that, the NASDAQ is really underperforming the S&P. The NASDAQ 100 is also breaking out. It remains positive with the Elder Impulse system. But if you look at this, the BPI just barely ticked up. That's another thing to be slightly concerned of. We're seeing a negative divergence that way. Then when we look at the Fibonacci levels, we're coming up to the 61.8% retracement. We're about 60 to 70 points away. Will that offer overhead resistance? But on the weekly chart, we still remain positive overall with the Qs. The small caps had a fairly good day. They were up over 1%, but still showing a lot of weakness overall when you look at just the index. Looking also at the Russell 2000 small cap index, we went back above 50 with the RSI. The MACD is still remaining positive. But when you compare small caps to the S&P, they are back to really underperforming. The small caps have switched back to positive with the Elder's Impulse system. Here's another thing though, longer term, and just looking at growth, we still remain in an overall uptrend, even though the index has been coming down. Now we look at mid caps. They're still below their 50 and 200-day moving averages. It's still below this pivot level as well. So the index is not looking all that positive. It has switched back to positive for the Elder's Impulse system. But when you compare growth to value, the mid caps are just screaming to the upside right now. We're still well above 100 with our micro cap index. We're still looking at a longer term negative divergence between the Dow and the transports, and we're seeing real weakness in the utilities as of late. The dollar index did have a fairly good week. It was down on Friday, but it's trying to rebound. Then when we look at the home builders, the S&P was up. The home builders didn't partake as much in the overall upward movement. So the ratio is falling just a little bit, but overall the relationship is still pretty strong between the two. Keeping an eye on the financial sector, we were up 0.82% on Friday, but still in a downtrend. The financials are really underperforming the S&P. And the regional banking ETF, after bouncing back up against the financial sector, it came down in Friday's session. Looking at bonds, where bond yields were down slightly, so that means bond prices were up slightly. Looking at this longer-term correlation, we're still seeing something that we haven't seen in a long time here with our longer-term measure of the relationship between the two. Shorter term, it is still improving, but they're having a tendency to go in opposite directions. And the spread between the S&P and the long-term bond ETF is starting to widen. This is one I haven't shown in a while. When you take the closest month is the 1-month yield and you subtract the 3-month yield, you would think we would get a negative number. That's what we would have in a normal situation. But this is starting to spike up again. That could produce some short-term uncertainty. We're also looking at the 3 to 7 year bonds and comparing them to the S&P 500. This ratio overall continues to fall, and that could be positive for stocks. An update of some of the charts that I used in the supplemental video, where when I did the video, we were crossing negative with this ratio and really going down. Now we're seeing a lot more uncertainty right now as this ratio is going up. Also, we're seeing the closer maturities to the further out maturities. Where it had been falling down, things were looking a lot better. This is starting to spike up again, so that's a bit of a concern. Then when we compare the S&P to bond yields, we're still looking okay overall. We're headed towards this potential soft landing area. Growth is just really outperforming value right now, where value is really underperforming growth. Our long-term chart, we still have not been able to break above this red line with the special K. And then looking at our MACD on a weekly chart, we're still going up with the MACD overall, suggesting that this breakout above the trend line is legitimate, at least for now. An update of our possible positive scenarios. This is more on the negative side. When we look at the 19-day exponential moving average of the advanced decline ratio, we're still below zero based on price, and we just barely came above it based on volume. Price is what we want to really see turn more positive. But when we compare growth to value on a longer term chart, ever since February, it's been doing really well. It came down a little bit in Friday's session. But the Qs are really outperforming the S&P. That's more to the growth side. Discretionary is not doing all that much. That's more to the value side. Large cap growth is outperforming large cap value. Then we look at our growth to value ratios. Large caps, mid caps doing well, but the small caps are lagging behind. We're seeing strength in small cap growth that we're not picking up in this ratio. Here's another positive sign. The S&P to utilities ratio is starting to show some improvement and actually breaking out. That can give some really good support to the S&P. But we're just barely below zero now. We're still negative with our 5-period moving average of the highs minus the lows when we look at the Amex, NASDAQ, and NYSE. If this was really a strong rally, we would want to see this number going positive, and it has not done so. Longer term, when we take a 50-period moving average of our highs minus the lows, we're still above zero, and we tick down just slightly. Our indicators just barely come back above zero, so that's slightly more positive. 2-year Treasury yield, it's starting to go back up. We don't know if this spike and then fall after that is going to give some more support to stocks. This is giving support to stocks. This ratio between staples and the S&P continues to fall, so it's looking like these spikes in here were valid. The only problem with this was generated and then we went up and chopped sideways for quite a while. The strongest signals we get from this chart are when we hit some kind of a bottom and then shoot up out of that. That's what has happened previously. It hasn't really happened this time, so we're a little bit gun shy of this chart. So what's our outlook for Tuesday? Earnings season just keeps going on and on. The technicals were showing that we're rebounding, but there are still numerous underlying negatives that I tried to go through with the charts. On Monday, we'll get the FHFA Housing Price Index. We'll also get the S&P Case-Shiller Home Price Index, as well as consumer confidence. And then the whole list of geopolitical events. We'll have to see if something develops over the weekend concerning the debt ceiling. That's more of a short-term focus for the markets. Looking at the Stock Traders Almanac statistics, we have now completed options expiration week. That tended to be more up than down. Well, this year it was also up. Looking at just May 30th, where we're pretty positive overall. The Dow, S&P, and NASDAQ have a historically positive chance of going higher. And then over the last 72 years, we've been more positive than negative as we get ready to finish out May. We're on the 21st trading day of the month on Tuesday. We're looking slightly positive when we look at the green dashed line. We're starting to get towards the end of May, so the green line and the black line are showing some improvement. Then when you compare May to the rest of the months in the year, it tends to be weak, but it's still positive during a pre-election year. Then looking at what happened back in 2011, this is basically what the S&P has been doing. The black line was the S&P back then, where we did see some weakness. It tried to come back, and then some more weakness going from late July into August. That's also what Shivako Capital is pointing out in this chart. So our scenarios. Hard to go with the down one right now, especially because we closed above 4,200. There are still lots of negative divergences, a lot of negative things in the background that we're seeing, but the technicals are improving. But it's still really hard to go with the up one, so we're still going with this sideways trend because the ADX, it's back above its moving average, but it's still below 20 overall. It is positive, though, because the green line is on top and it is advancing. So the warning signs, we still have a lot of negative divergences that we're dealing with. We have numerous signs of weaknesses that are developing under the surface in the market. The VIX is still showing a lot of complacency. The NYSE advanced decline line is still below that trend line. The NASDAQ cumulative new highs, new lows, that's also showing weakness, especially when you compare it to the S&P. It would even be more pronounced if I showed it compared to the NASDAQ. The small cap index is underperforming, and the mid cap index itself has generated a recent death cross. Earnings season continues, but it should be coming to an end at some point. So let's look at the positive signs that we're seeing right now. The Copic curve is generating a buy signal. The Pring bottom fissure, we're still saying it's close, but it pretty much has generated a buy signal. The seasonality and setups that apply to the whole year, those are positive. It looks like we're switching back to being more risk on as far as our posturing is concerned. Lower price levels may provide some support. As we break through this resistance, if we start to come back down, some of these areas may end up providing support. The S&P is outperforming utilities. That's turning more positive. The NASDAQ and NASDAQ 100, they're continuing on their breakout these days. And the staples to S&P 500 ratio is declining. That's positive for stocks overall. And then we have small and mid-cap growth, which is still showing strength. Will some kind of a resolution in the debt ceiling produce some kind of a short-term rally? So what's our conclusion? Overall, the S&P, it's turning more positive, but there's still these negative things going on under the surface. Short-term, we're back to pretty much positive. Intermediate term, it has turned back to positive, but this is where we're seeing a lot of these negatives coming from. Longer term, we still remain positive. So thank you. I hope you have a wonderful Memorial weekend. Have a great barbecue. I will be posting the weekly video, the intermarket analysis video, and the deep dive video. Might be a little later than usual because of the extra day that we have to get these things ready. So I hope you have a great weekend, and I will talk to you in the next video.